All right, good morning. Welcome back here to Trader Minute. Great to have you aboard. Market off to a bullish start here this morning. S&P is up about 14 points, but you can see the market is trading lower than where it gapped to. It gapped up here 2907 on S&P futures. Initially rallied and then drop, consolidate, drop, and now we have a little kind of relief rally coming in here. And here we are at this kind of magic number, 2,900. Now, you know me, I'm not much of a believer in, round numbers and the significance of certain levels just based on the fact that, they're a round number. I don't buy it. I don't subscribe to it. I don't think it's something that in most cases matters at all. But in some cases it does. When does it matter? Well, it matters when it's the first time a level is getting hit, right? So the first time a major level starts to come into play. So we may see this in the future, but the S&P 500, right? If we come in here, let me log in, pull it up on stock charts, a little easier to see. But let's come in here to the SPX, and we'll get rid of all our indicators. And we'll just take a look at this from a weekly standpoint, so it shows us a lot bigger time frame here. But you can see that market up here around 2,900 here on S&P on the S&P. When we get to 3,000, 3,000 is going to matter. Meaning we start to get a little bit close. They're going to take it the rest of the way there. They're going to want to print it. And if we start to push a little bit above that, they're going to sell it off back to that level. We're going to spend a little time at that level. And when we hit brand new levels, it's common to see that. When we hit 2,000 on the S&P, you can see, it was a multi-year consolidation around this level. Right? It wasn't just a few days. It wasn't just a few hours. It was a multi-year consolidation around this 2,000 level. And so there are some levels that matter, and generally those are new levels, brand new levels for the market, and the big round numbers, right? You say, well, why does 2,900 matter, Jeff? Because, look, we've hit it before. This isn't a new number. It's not one of the big round numbers like a 2,000 or a 3,000 or something like that, and you're absolutely right. There's another case where some of the round numbers come into play. And that case is when there's nothing else for the market to look at. Right now, there's no economic data. There are no earnings. There are a few tweets from U.S. President Trump. There's China, kind of greasing the economic wheel a little bit. But let's face it, when it comes to just overall news and real information for the markets, there isn't much. The markets don't have a whole lot new today to go off of that changes things fundamentally than what they did yesterday or the day before. Now, last week they did with the Fed. But we have the Fed quieting down a little bit this week. And so when we go through a period where it's a little quieter, the big round numbers kind of matter a little bit more. And that is the sole reason why this morning, I mentioned 2,900 and said, look, I don't think the market gets too far away from this. And if it does, it comes on back. If it breaks on down, it probably snaps on back unless there's a significant catalyst. Now, the way this market is torqued right now, a little bit of a catalyst or a significant catalyst, the market has plenty of juice to fly higher, right? But without a catalyst, the chances are pretty good that we see some just dancing around this 2,900 here for a little bit. And if you want to kind of look and say, well, is that catalyst on the board? Is it out there? Just take a look at bonds. If there's a big move in bonds, then yeah, the catalyst is out there. If there's not much of a move in bonds, then no, there really isn't that big of a catalyst, out there for the market. So, it doesn't have to stick around 2,900, but chances are pretty good that, rips above it will get sold down to it, and dips below it will get rallied back to it. And that could be for a week or two here, and we could see kind of some of that consolidation really come in. Now for the challenge, we haven't had many triggers here lately. The last 3 days, none. Visa was our last trigger. The day before we had Disney. We kind of had this 3-day period where we had 4 triggers all come in a row there. This morning we do have a trigger on the board, and it's Triple D. This was a new addition to the watch list from the test run that we did. Triple D is triggering bearish here today with the downside 3-7 crossover. You can see with the slow stop. I mean, this is a company that, I would not be surprised if the word bankruptcy comes up in the near future. But that said, this is one that's on the watch list, and I'm willing to trade it on a signal if and only when the options are really good. And if we come in and we look at the options, they're kind of a disaster. The 8 strike, which is 30 cents away, which is 4% away, 3.5 to 4% away. They're 30 cents with a 7-cent spread. It's a 20% spread on an out-of-the-money option that's 4% away. It just doesn't make any sense. We would need to see the stock tank $1.50 or so to really put in some great gains. It just is. It's just one of those. It doesn't. The option's horrible. Yeah, we could go to the 9 strike, right? But we're talking about still a 12-cent spread here on Triple D on an option that's less than $1. I mean, that's a 25% spread. So 25% to get in, 25% assumed to get out. Yeah, we might be able to cut that a little, but 50% just to enter and exit, that is steep, and it just doesn't make any sense to take that risk of, when I know that, hey, half my trade is gone just because of the mechanics of entering and exiting. So basically, if the option goes against me or the stock goes against me, I mean, my options are going to get absolutely clobbered, and it's going to be very painful, very painful. And if it goes my way, I may not make a dime. In fact, I could lose money with it going my way simply because of how the options are priced. And, that's what the regular monthly July options. If we come into some of the weeklies, they're even worse. If we come into the Junes, which are really short term, they're even worse. So it's not like we can go out and say, well, if we go out here or do this strike price, it gets better. Maybe in the August they get a little bit better spread-wise, but the pricing and the implied volatility because of it being earnings or them having earnings before those options expire, it's significantly worse. So it just doesn't make any sense for an option entry here with Triple D, and it's one where I've traded this for challenges in the past, and we might be talking about a stock where the options are permanently changed, simply be after this big gap down on the earnings. And if Triple D stays below 10, I would not be surprised to see the options stay like this. So it may be one that I just have to remove from the watch list, as it doesn't have a whole lot of hope in terms of tradability. I've been watching it each day, just looking at the options, and they haven't improved. I mean, they've been this way here for a few weeks, and yeah, so not going to make the trade there on it. We do have some 3-7 crossover action to the upside here today, but mostly with stocks that had it yesterday and then failed into the close. Things like Facebook, things like Schlumberger, things like Alcoa. I'll have some 3-7 crossover action on them this morning, but most of them, they're coming off new lows. It's not a signal of brand new trend. It's bounce mode here for these. We saw Bristol Myers yesterday, and I was a little kind of head scratching why Bristol Myers didn't trigger bearish yesterday, and had a downside 3-7 crossover. Opened above the 20-day moving average, closed below it. You can see where the Stoke 39.1 is. The visual picture is pretty strong. But as I went back and looked in the data, it was one of those where the consolidation risk was too high. With this type of season, this type of price action that it's had over the last 6 weeks, it's one where the chances of consolidation are just significantly greater than trend, and so did not trigger. Now today it has a 3-7 crossover to the upside. 1 day later, which is common. We see that with stocks that are consolidating. They'll have crossovers one way or the other. Back and forth here with them. And so we see that with Bristol Myers, but it is not triggering bullish here this morning, just like it didn't trigger bearish yesterday. The other one I was a little surprised on yesterday was Verizon and why that didn't trigger bearish. I went back and looked at it. It was the same thing. Just consolidation risk was too high. After moves of the percentage that we saw yesterday, it is very common for Verizon to have a little bit of snapback and not, really trend all that much. We see a small snapback here today, but it still could trigger. Today or tomorrow or something like that. But bottom line, no new triggers on the board. And we looked at the watch list on Friday and kind of showed and talked about a bunch of where a bunch of the stocks were, and we just have a lot of stocks in this area where they're not going to have a fresh 3-7 crossover anytime soon. Right? Here's an Apple. Right? And Apple's kind of changing its stripes potentially a little bit. We see the 3-7 pushing back above 50. We had the crossover down here. It never triggered bullish because of the depth of this pullback. But, we have a little pullback and, higher low come in. It could certainly trigger bullish, but it would need something like that. And a lot of things out there are in that situation here. In the market. No, I was asked yesterday about if I would go take a look at Disney, Visa, and GLD as one of you is, at least one of you that I know is still in them, and share my thoughts on them. And I commented back that I would. But this won't be a normal thing. When I exit a trade, I'm done. I'm not watching it. I'm not paying close attention to it. Even when I'm in a trade for the algorithm, I'm not paying that close attention. There's no reason to. I got it out of the corner of my eye, and I'm not watching every tick and analyzing every little move and stuff like that. So I'll share my thoughts on it, but the thoughts are in the context of the challenge and in the context of probabilities based on the algorithm. So gold I've commented on a couple times. But gold, it moved in 1 day, it moved 2 average true ranges. The next day, it moved another 2 average true ranges, right? And I exited rather than change the option because we would have been down to 2 contracts, would have had a 200 delta bottom line. It just wouldn't have gained or lost much. So wanted to have that cash for the next signal. But once a stock moves 4 average true ranges from its trigger price, the chance of consolidation is very high. The chance of breakdown isn't all that high, though it could happen, and if it does, it's painful. The chance of further rally, it can happen, but it's not as good of a probability as, the first 4 average true ranges. But the big probability is consolidation. And so, is there a reason to be in an option trade when it's consolidating? No. There just isn't. And as far as, do you buy it right here or something? For me, I need some reset. Ultimately, I'm bullish on gold. Ultimately, I do think gold goes higher. I'd love to see it pull back to 124, maybe even 123. Get that next 3-7 crossover and be able to run with it. But it's not there yet. And in terms of just what the probabilities are right here, probabilities are for consolidation, not for a big move up or a big move down. And so I think with gold, you're waiting for a catalyst to get a big move up, big move down in this element right here. And if you don't get that catalyst, you're probably in a position of just kind of waiting and waiting and waiting, which could be killer on an option. Now, Disney's a little bit of a different story, and Disney, we would have been stopped out with the time stop here on Disney. Here, the auto exit date 6:11 p.m. So today, this afternoon, we'd be knocked out with the time stop of it. But it believe, and sorry about the screen there. Let me go grab it. But I do believe that no, it didn't hit that second price level again, right? When I'm out, I'm not watching these things very closely. But it did. It did hit that secondary price level yesterday morning. So, would have had that second trim yesterday morning with the number of contracts that we had. Probably would have been fully out. But this is one of those where. We got the average true range move here on it. It's just one where, okay, there's a little pullback on it. It's not extremely bearish in terms of the nature here, but it's also something where I wouldn't be surprised to see a bear signal come on in. We could easily see a bear signal come in because this would be a lower high if we start to see it weaken further. Right, so it's just one. Okay, had a nice move, played the probabilities, went, and the algorithm, basically would have us out, yesterday morning. But I don't think you could be too excited about the price action the last 2 days. But at the same time, I don't think it's devastating or disastrous, and we're not seeing any brand new downside signal really coming in. But it's one where if I were in, I would not be feeling very comfortable, very, very much in either direction here with it. And then last, Visa here, and this one, I mean, beautiful move, brand new high here on Visa. We captured a good portion of that. The 170.51 was the average true range target on that. Hit it. So, it does have a good probability of moving another two average true ranges, but I would make sure the exposure is cut significantly here for that. But, what can I say? Visa every single quarter sets a new high, right? It's now set a new high this quarter, and it could keep going on a new high, but, Visa's just one of those stocks out there where it just pays to buy the dips and doesn't really pay to chase the rips. And yeah, I know we chased a rip here a little bit, if you want to say we chased, but we didn't kind of chase it after a push into a brand new high. We chased it in the breakout mode with the signal. So chasing right here, it's a dangerous spot in my opinion, just given the overall market. As I'm of the opinion that I do think the market has some trouble coming. But, at the same time, when you look at something like a Visa, you don't see a lot of, downside signal there with it. Okay. So anyway, that's, my thoughts on it. And, that's not that they matter all that much. I don't follow the news all that closely here on them. I watch it out of the corner of my eye, and if there's something significant, great. But all the little kind of ups and downs and opinions, I don't pay too close attention there to it. As it's simply it's simply a noise factor here. But all three, Disney, Visa, gold, they're all three things that I'm very bullish on longer term, right? But there are ones where I do think in the summertime market, I don't think they're great buy and holds in terms of short term options. I think you can play them, but the buy and hold set element I don't think is very realistic. If we go to something like a Disney, right? I mentioned my long term position. Where I had shares since my daughter was born, basically, and I've been adding to them and adding to them and adding to them year after year after year. Disney jumped here to 130 on the analyst day, and I mentioned this day. I took off 90% of the position, basically took off all of the gains of the position for many, many years. And I mentioned I wouldn't be getting back in. Not anytime soon. I would need to see a big reset for the stock, and I know it went up a little bit more and then it dipped. And this isn't a reset, right? This is not a reset. This is a trading element, not an investment reset. An investment reset comes after a big pullback where valuations are reset. And, there's no resetting of valuations here or anything like that. How low would it have to go? And I don't have a target. I don't have an idea, but I know it's not going to happen in the next couple months. So I don't even really have to look at it. I just kind of ignore it. And I'll reassess it as we get into the September-October timeframe. But I suspect that I'm probably not going to be in it until, jumping back into Disney from an investment standpoint until we have a pretty solid bear market in U.S. equities, and that may be a little while, right? That may be a little while here. In fact, we could go another 4 or 5 years without that. And if you look at some of the things going on out there, it's one of those where we talked about the bull market case. We talked about the bull market case a little bit ago, right back here when the market was down and where the bear case was easy to make. And we went out and we made the bull market case, right? Right now, I think it's still a little difficult to make a bull market case, though, a little easier than it was. But it's a little tougher to make a bear market case right here. Not too difficult. I don't think we're in the same type of pivot area that we were right down here. But, one of the things that I think the bears underestimate in this market, and I'm not talking about the trading bears. I'm not talking about where the market goes in the next 4 or 5 days. I'm talking about the market long term, year after year after year. I think one of the things that the bears underestimate is how unusual this bullish rally has been. When you look historically and you compare this bullish rally to other bull markets, we have not had the same economic growth. We have not had the same action in bonds. We have not had the same actions by the Fed. I mean, we've been growing at a pretty slow, mundane, soggy pace. And not just here in the U.S., but around the world. China's growth has been slowing. Europe, it's like, wow, can it grow at all? Japan has been lost decade after lost decade in terms of growth. We have not seen a high economic growth period for quite some time. If we see some of these trade deals change that, if we see some of the policy changes change that, if we see the fact that the Fed is cutting rates really start to push some economic growth, and we start to see, historic growth numbers start to come in, market hasn't even started to go up. The market could easily double from here, and I know that's blasphemy to say, but let's face it, the market doubled in 5 years without much growth. It went from 1,000 on the S&P in 2010 to 2,000 in 2015. I mean, the market doubled in about 4.5 years. rewind or fast forward for another 4.5 years, and it's almost at another, another thousand chunk here on it. Not a double, but that we're not talking about coming off of a low where, okay, yeah, the S&P was down here at 500, so 500 never got that low, but a double on a bounce is okay. Well, we had a huge sell-off, so double isn't all that hard. Right? We're talking about a double that came in when the market was sitting near all-time highs, and a double coming in. And that's without real economic growth. That's without the big historic economic kind of trajectories. Imagine if we start getting that in. And that's something the market isn't accounting for right now. Now, we can make an argument of whether that's going to happen or not, right? There's all sorts of variables and all sorts of things that would have to happen. But if that were to happen, to see the S&P trade at 5,000, 6,000, 7,000 in the next 3 to 5 years, that's not historically absurd. That's not something where you look at the historic norms and go, well, that's absolutely unusual. Yeah, it sounds ridiculous, and it doesn't make sense given the valuations and the earnings and revenue growth right now. But if we were to start to see growth really come in a way where we haven't seen it in this bull market yet, to see the market make that huge move, and I know the bears and everybody's going to be calling, well, this is a melt up and this is blowing off the top and using all those terms, but if you really go look at it fundamentally, it would be a pretty normal type of thing. And not a melt up, and not a bubble, and actually something built on growth. What needs to happen? Well, we need to see a trade deal between the U.S. and China. We probably need to see the Fed continue to cut rates. We probably need to see some sort of, stimulus, continued economic stimulus out of China, and even something coming in from the EU and from the U.S., where there's kind of this global stimulus package that comes in, let's face it, there's a possibility that we do see some of those things ultimately come in. And again, this has nothing to do with this week or today or tomorrow. And ultimately, in the short run, I'm more bearish than bullish. But, in the long term, I think that's the scenario that the bears are forgetting about. That's the scenario that the bears absolutely fear. And it's the scenario that I don't even think the bulls are counting on yet. So, anyway, my couple thoughts there on those things, and what could happen. Obviously, we'll see what does happen, but we can see a couple cookies crumble the wrong way, and see the market trade back down here to 1,000 on the S&P. Right, that kind of scenario is always on the table. But anyways, thanks for hopping on. Have yourselves a great day. I will talk to you later. Take care.